Hello, all viewers. Most welcome to all of you friends over here in Phoenix Institute. Friends, we are welcoming you for the sessions which we will provide you on YouTube channel as well. That is specific to the subjects which I am dealing right now for your FAR. In the CPA curriculum, you have to start with working on the financial reporting basics. And this session is discussing about the financial accounting and reporting, which is governed by the specific rules. Friends, my name is Nikhil Gupta and welcoming all of you at the Phoenix Institution platform to provide you the virtual learning for your CPA. Friends, first topic today discussion that we are moving into is the principles and certain assumptions on the basis of which the financial accounts and the reports thereby are prepared. Friends, now we are moving on to discuss about which are these principles. This video will be a short brief discussion about this topic, but I will be dealing with certain examples. So not just looking to the screen, you will have to focus about what I'm going to write, the examples which are very crucial for all of you to discuss upon. Friends, in the principles, here we have the principles which are the philosophy of any treatment in the accounting that you do, means the philosophy that is governed by maybe the old rituals or some technical reason, the business principles behind that. Now into this principles, today is the first thing which we are discussing. The historical cost is one of the principle of that. Okay, now as if you have understood the basics of which are the financial statements, you already know what is the balance sheet and what is the statement of profit and loss. Guys, now looking to those two statements, when we talk about the balance sheet, this principle is a very clear guidance and a very objective principle which states that the cost of the financial asset, I'm talking about fixed asset and financial asset both together. Guys, the first thing, when you purchase the asset in your business, what you will value, obviously the value would be what you have expense out of your pocket. So the principle of historical cost, I would like to just note down something. So just keep your eyes on the screen, guys. Now, a simple thing is when I value something, when I purchase something, some out of pocket money, I would have done it. Now, for that thing, I would have expended some amount. And so to expense that thing, the monetary value which I have paid is the cost I have incurred. Guys, you always have to focus about the cost, etc. So here I am discussing about how do we deal with the cost part. Exactly, when you pay something, your cost you should take in the financial statements, and in the balance sheet you're gonna put the value of the asset. I hope friends you have understood this part. Now friends, the focus is on the specific aspect that deals with the content. How do we value the cost of asset? You very well know that when I purchase some asset, what I do, I'm going to write over here, friends, in the valuation of the asset, the cost price which I pay to purchase that kind of asset, and it may be the price to develop that asset. Even in the part of intangibles, you would learn that thing. Now, in addition, if at the time of purchasing the asset, let's say I have purchased machine, at that time transportation cost incidental to put to use the asset. A very important thing is put to use that asset, whatever the cost was incurred. Now this cost is going to be there in the statement of position, means in your balance sheet you're gonna put on the asset side. Now this value is capitalized. Now friends, put the harmony for the accounting all over the globe, the US GAAP has also followed the value basic principle, that is cost principle. Because then if we consider fair value, everyone would think in their own benefit and will have their own valuations. So friends, to put it in a harmony and very objectively, it is stated that the balance sheet should include the asset at cost value. So this is the implication of the historical cost principle. Friends, I hope you would understand this topic. Now, moving on to the next part, historical cost. After that, the revenue recognition. Friends, all over the globe, the IFRS, being the Global Financial Reporting Standards, and where the FASC is making these standards, they have made the IFRS 115 for the revenue to be recognized. Friends, on the same line, the US GAAP do also have the revenue recognition principle. But in nutshell, if I tell you, this principle is establishing the sales part by any seller, whether the seller of the goods or provider of the service, when I should record the sale. Friends, simple line is that you record the data. Why do you do that? Simply, you estimate that your sale has been done, but only monetary receipt is pending. Friends, it cannot defer your sales. Monetary receipt won't defer your sales. You know it clearly. So, in this regards, your whatever value of goods you have already delivered becomes your sales. You recognize when you have done your part of action. So that's why it is recognized, it is recorded and earned. And think about the expenses. If we talk same way, the expenses are payables, and it is a liability when you have incurred the expenses, not when you paid. So mercantile basis of accounting is following the revenue recognition principle. Friends, the detailed guidance is there into the IFRS and IAS, or the UK IAS is also there, followed by the different countries over the globe, and that is in same line with US GAAP. In the revenue recognition session, we will learn it in depth. Now, friends, we are talking about the matching principle. The principle which states that in the current year, the expenditure and the revenue earned in the same year should be accounted. Same line, the closing stock is reduced from the current year cost of sales. Why? Friends, closing stock is a stock which is not being sold. If I consider the value of the sales, I should reduce the cost of sales. Friends, the closing stock which has not at all been sold in the current year should not be part of its cost, because it will become the cost as opening stock of next year. Just imagine, whenever I'm speaking about these examples, you just need to connect and get very strength, and you have to be very strong in your concept. I'm delivering the examples so that you can always connect with the examples, can apply that concept in your examination. Guys, so as I told, the closing stock is reduced from cost of sales to match its cost in the next year and to reduce from the current year. Another example, if I put the statement of income, that is the statement of P&L, if I put it in horizontal format, now it is debit and credit would be like this. Friends, the current year, whatever expenses, we put it here, including the cost of sales is there, and the incomes, like we have the sales, we have the stock. The closing stock is taken away from the current year P&L. It would be there into the next year. But friends, be careful. In the expenses as well, you do recognize there are certain outstanding expenses, unpaid expenses, which becomes your liability even if you haven't paid it, just because it is recognized, it is payable in the current year. I hope it is clear to you. So the outstanding expenses, same way when we talk about prepaid expenses, what happens that we reduce the prepaid expenses into the current year expenses. We add the expenses outstanding in the current year. Why? Because the timing was important. The principle of matching states the timing of the expenditure is in current year, you should add it. If it is not in the current year, don't go for the payment. You think about payable or receivables. So that is where connection of the recognition principles comes with the matching principle. Whereas matching principle matches the revenues and expenses, revenue recognition principles is focusing on only the revenue. I hope you now understand that these principles are nothing but focusing on a particular component into the financial statements. Now, going on further, we have the another next principle that we are focusing upon, the principle that focus upon, that is consistency. Now, friends, the principle of consistency is making the harmony for the different accounting policies there in the financial reporting world. Now, hope you understand the options that you have available with respect to depreciation, with respect to inventories, FIFO, weighted averages, and LIFO is there, and specific for the depreciation methods are also there. So, guys, exactly there is the different options, and you will have to select particularly such an option and have to follow thoroughly, consistently in your business. Friends, consistency is the key for the comparability of financial statements. In a nutshell, what happens when you apply the same accounting policies from a year to year basis, your financial statements are comparable because the financial accounting and reporting are needed on a very consistent basis and have to be I'll say on a comparable basis for the previous year as well as current year data. Means we have not to follow simple 1 year preparation of financial statement. We prepare it comparable for previous year as well. When you look at it, the balance sheet of particular organization, that is your homework today in this session, you will see that the previous year data is at the right of the column and the amount column at the left hand part is the current year amount. So that makes it comparable. So I'll say it like this way. If this be my previous, this is current year's 2020 ended, December 2020 ended statement of P&L, and in my statement of P&L, I'm making it vertically. So the sales I put, the valuation of the total amount of sales, cost of sales, the different expenses, I will put the value current year and the previous year as well. Now, let's say it was 60,000. I put it the value of thousands, and previously it was just 30. Now, a very simple observation you can make that the sales has doubled. Why it was so? That will become the case of particular investigation later on. Okay, that's the different subject. But this is how the comparability is maintained. But guys, to make it really better comparable, consistency of different accounting policies is very crucial. Now, what kind of examples you can expect into this session and this topic as well, that you will be given one of the financial reporting scenario of the organization, will be whatever, but you have to decide which was the principle got violated in that. So now let's say if there is a scenario provided, the organization in the year 2018 they followed FIFO. In 2019 they converted it to LIFO for inventory valuations, and then again in 2020 they have made it to W weighted average. But guys, this is not showing any consistency. That is something got violated. This statement, the principle of consistency, states that the same accounting principles must be followed from period to period. but it is a base of comparability. I hope, guys, you have understood my words clearly. Now I am moving to the next discussion. The next principle we are talking about. The next principle is about the full disclosure concept. This concept, the full and faithful disclosure, indicates that the organization shall follow all the content related to any component in the financial statements. Now, let me give you the brief about the same. The full disclosure is followed by accountability of the management, because shareholders don't know what's going on day in day out in the company, but the managers are responsible to provide this data by way of financial statements, and that's why the financial statements must include the notes to the financial statements, which is a detailed description. So, to follow the full disclosure, we shall have the notes to the financial statements. Now, I'm explaining it over here, guys. Just stay connected. Over here, when we think about any balance sheet, okay, the different assets that we have, be the furniture, fixtures, property, plants, and equipments are there, office equipments are there. There are a lot of different assets in one head. Even in a property, plant, and equipments, the organization may have various buildings. A factory building, the head office building is there, but the total of all of them is shown into the balance sheet. Now, do have the balance sheet, let's say for the previous year, or we even talk about the current year, as you can see, guys. Now, all over the way in this balance sheet, if we think on, we do have the property, plant, and equipment. There were the assets. Now, in this asset, I would simply put up the values, like one of the value I put is 80,000 of the same, and it was 68,000 in the previous year. It shows a simple thing that the value has increased. But guys, don't you know how you get that there are a lot of different assets into this 80,000 amount, into this 68,000 amount? How can you get that? So that needs a full disclosure about method of the valuation of asset, whether fair value, the cost method. You will gonna learn about these methods, but the most important principle states that these all the things, the depreciation method of the asset, impairment on the asset, the fair valuation hierarchy, how it was derived. Many things are there for these assets. Whether any assets is on the charge of the banks, has been mortgage or something, but that we need to provide into the financial statements. That will be the follow-up of the full disclosure concept. I hope, friends, you understood this principle. The important note was about the notes to financial statements. I hope you are getting into the understanding. Now, the next we talk about objectivity of the financial statements. Friends, obviously, any data in the financial statement should have the backup or the proof of how it was derived. It should not be vague, it should not be the sky limit or something. Obviously, it should be free from the errors or any of the biasness as well. Means, whenever the data of impairment is there, the management of organization must disclose that data. Friends, independent data should be there, which shall not follow from any bias from the management person or something. Objectivity is very clear. Historical cost is objective thing, because everyone can show the invoice of whatever they have purchased. If the business have purchased something, it is supported by the documents. Means, let's say we focus upon the purchases, we do have the different invoices that we have received from our supplier, and whenever provided the sales, we have given the goods to the customer, etc. Even that amount, even that thing is also supported by the documents. Friends, we do have the invoices. Be any kind of expenses. The electricity expenses do have the invoices. The rental expenses might have the rent agreement. That is supported by the evidences, the simple proof is there. That is followed by objectivity principle. I hope, guys, you understood it clearly. Now the next thing is verifiability. Now, simply verifiability is supportive to objectiveness. When I do have the proof, it is becoming the verifiable document for any transaction into the business. Now, I hope, friends, you understood that this verifiability will improve the objectiveness of statement, and ultimately, by that help, we can achieve the proper consistency and full disclosure of the financial statements. Friends, these principles are also supported by the basics of the management responsibility. You will learn those things in your auditing subject. Guys, just stay connected for the same. Now, we are focusing upon another aspect, the separate entity concept. Now, a simple question I want to consider. Hopefully, you know that in your tax filings as well, you and your taxation presentation are different. Obviously, why do we follow the capital account? Why it is there? The base thing to discuss is that your business and you yourself is a separate person in eyes of the financial reporting. Friends, you are provider of money to the business, and on that basis the business is doing the activities of business. In the eyes of accounts, you have given the money to the business, and the capital you have given to the business is the liability of business, and that is why we put the capital with the liabilities. Alongside the liabilities, we put the capital values. Hopefully now you understood that the business owners withdrawals are also there, and all these withdrawals are reduced from the capital. Money taken away from the business by the owner, money given to the business by the owner. The capital transactions are considered for the owner and the business. Separations are there. Because of this principle, the capital by the owner, withdrawals, etc., are recorded. I hope, guys, you can understand the valuations as well of this thing. Now, we focus upon the next important assumption. Now, friends, separate entity assumption is also principle as well. An assumption for which I have indicated is something on basis of that one can always assume that the owner of the business is separate from the business. Exactly. In the eyes of law, let's say my shop is having some name. The Nick shop is something that is I have named it. Okay, so the Nick shop is not having the physical existence like we guys, we are breathing and we are talking to each other. But guys, that's why the business is separated from the owner transaction. But another assumption states that the long-term assets, why we focus on the long-term assets, short-term assets, you are known to the current asset, the non-current assets, why you are known to that thing. One thing you are clear that the business is assumed to have a long indefinite life. Here it is focused continuity and going concern assumption. The assumption, because of that, we bifurcate between something as the current asset or non-current assets, and also we bifurcate that even if today I have some daters, the account receivables, they will really gonna pay me because my business will obviously gonna continue. But friends, this assumption don't need physical presence in the notes to accounts. There is no express requirement to disclose this. However, there is one important thing to note down. Please be careful. If the going concern of the business is in danger, it is affected. Let us say that the business was having only one factory and the entire factory got burned in the big fire. What happens? Now your business consistency, your business existence is in danger. Yes, it was. But if it is a big corporate giant, let's say Google lost one of the data center, their business is affected, existence is affected. answer is no. So exactly for the same thing, the continuity and going concern is followed. However, once it is in danger, one have to show that the reason why the business existence is affected will have to disclose in the notes to the financial statements. I hope, guys, you will understand. The going concern is one of the majorly discussed assumption and topic in your MCQs. We're gonna see that thing as well. Just stay connected. The next thing we need to focus upon the principles relates to not only the guiding theology or the philosophy, but it also focus upon the valuations. What are the valuations? Let's say first focus upon the units of measure as well. We do have the cost valuations. We do have the fair valuations as well. You're gonna learn that in the coming topics. Also, the valuations like amortized basis, the present value of the future benefits. These are the things I'm listing upon on the screen, guys. Just see that these units of measurement is about the rupees that we put, the values that we put into the financial statements. There shall be a monetary unit only. We can consider for you can say kilograms or centimeters to value the any substance or something. Okay, that's not considered in the financial statements. Now, what is the timing when you prepare the financial statements? Just think upon the statutory requirements are there that it shall be every year. A particular year must be there. The accounting year is there because the business is assumed to have indefinite life. I cannot sit back to see what can be the profit. I have to focus that every year what is the profit, and to calculate that profit I break down that indefinite life into the small pieces, and that is period of account. I hope, guys, you clear about that, because if at all I just be in you say blind era that my business is indefinite, I don't want to calculate the profits every year what I'm earning. No, guys, even statutorily you are required to prepare the financial statements. Statutorily means by the different laws into the US territory. Now, another important assumption, but I will say rather principle, it is the conservatism, and which is self-explained over here with the examples. The examples here indicated, the conservative approach is always to be little prepared for any difficulty that may come in the future. Guys, why do you record the outstanding expense? Friends, you have gone through in your schooling time for the commerce calculations for outstanding expense, but you do it because of conservatism. Friends, another aspect, why do we record certain losses that may come about contingent liabilities? Yes, friends, contingent liabilities are there which may or may not come but depend upon the future circumstances out of our control, but still we record it if it is virtually certain, if it is probable. Guys, that is the examples for this principle. Friends, here I'm connecting these words that you gonna learn into the coming sessions, because there are specific topics for which I'm putting down the examples right now. Friends, the contingent liability topic is the basis of the principle conservatism only. Friends, I hope you understand. It's very basic to always be prepared for the losses that may come to you and be having some reserves for that. That is the theology behind this principle known as conservatism. Friends, please highlight the last example, very important, that relates to that inventories are valued at cost or NRV, whichever is lower. Let's say that I do have in my shop one of the iPhone, and that was iPhone 12, but its price is now 65,000. but I know that sooner one of the new feature with a new feature, the iPhone will be there. The 13th iPhone or 14th iPhone will be there, and I'm not able to sell this 12th iPhone 12 more than 62,000. My value of the iPhone with me is only 62. I should be prepared to bear the 3,000 loss because I bought it at 65, but I'm not able to sell it at more than 65. There will be a loss, and I have to record the loss. Conservatism will make me to do that. You're gonna learn that in your inventory. Yes, friends, the chapter will deal with in inventory part. But now, be careful what actually goes on in these principles when we talk upon really these principles are guiding principles or so. Friends, by the different US GAAP, these all principles are somewhere imbibed into, implanted into the various US GAAP, various IFRS standards that we will discuss in times to come, in the sessions to come. Now, here we think upon have some conventions are there, some protocols, some rules that changes the thorough principles as well. When I talk about that substance should be shown in the transaction. Now, what we do, guys, let's say my customer today, whatever the date it is, guys, but today customer bought the goods from me, but customer told me that after 5 days the customer will come. Payment is done. Okay, customer got me the payment. Okay, I got the amount as well. I got the so and so dollars, and I'm ready with the entire package as well. The box has been ready to deliver, but customer said, "Just wait. I want it after 5 days." Now the thing is that, do you have sold it? And the answer is very much clear. It is yes, because just the delivery was delayed. The transaction is over. I have ready delivered goods and the customer made me the payments. All things are done. So this is substance which I should look for, not just legality. Another example, a very beautiful thing example, which will be taken from the mortgage that you take or the loan you take on the banks. You are not the owner on the legal papers of the property, but when you pay the last installment of the property, I have purchased a home, the house, which is on the loan basis. I have to pay the installments, and once I pay the entire installments, it will be in my name on a legal papers. But taxation rules even says that, sorry, I'm the owner right from first day. Because who is the real owner? Who is really using that house? Myself. Who is maintaining the upkeep of the house expenses, etc.? Myself. So that's why I'm the real owner. That is one of the example to show the real substance of the transaction, not to focus on the legal aspects. Friends, another way I will tell you that you might have the mortgage property which is in the name of the bank, but guys, you will be the real owner for the purpose to depreciation. You can consider the depreciation expense in your books of accounts because you are using it. I hope guys you understand. And I'll connect you one more example. The lease examples are there, which you will gonna learn in the many different sessions to come. Stay connected. The substance over form is also applicable over there, where the lessee who takes the asset on a lease basis can record the depreciation. And yes, it is because he is the real user of the asset on a daily basis. Now, the next convention, materiality, that focus upon the presentation into the financial statements. Friends, if you know something called as the miscellaneous and other expenses, but it many times includes a lot of expenses. There are a list of expenses in that. Should I have to fully disclose each and every paise, each and every penny of the dollars into my financial statements? Can I just merge it with some another simple transaction and I can merge and show it as a total as well? Let's say we talk about cleaning expenses. In the cleaning expenses, I do have, let's say, the cleaning staff salary, I do have the cleaning materials, etc. But do I show it separately? No, I just simply merge it together. So, in this regard, materiality states that you can always shortify, you can always merge the little transactions, little amounts which are not so big, which are not so material for the user, for the reader of the financial statements. And that's why this convention allows to nullify the full disclosure and summarize that disclosure. I hope, guys, you understand it clearly. Friends, materiality is not always the amounts. It is many times connected to the implication. Let's say tomorrow there is a big implication on Google for the data breach, and that was intentional. See, this thing is not gonna, you say, big financial loss to those guys. But friends, what happens that at least this is a huge news for entire world, I can say. So that must be disclosed into the financial statements. Materiality is the disciple of the full disclosure concept. I hope you are understanding these words. And we are now moving to the practice questions for the same. Let's just connect and discuss it quickly. Friends, the following generally accepted principle illustrating the practice of conservatism. Friends, for your better understanding, I already have bifurcated the answer over here. The conservatism, what example is just connecting to it? When I talk about inventory value, the cost or market value, whichever is lower, that is following the conservatism, and your answer is option D. Friends, I will always like suggest you what is the best practice you can follow for your better practice. Each and every session after this, you should go for any of the materials that you are using for your CPA preparations and just connect with the session and do your best. Now, the next we talk about question number 2, the estimated uncollectible accounts like the bad dates related to your account receivables, etc. This is used by the past actual bad date losses that we follow. Now, which practice we are doing? Friends, what happens? The past sales were made and the bad debt happened today in the current year. I'm recording it right now. It's not about consistency because there are no different accounting options available for the bad debt and uncollectibles as well. So going concern is not connected. Once you are having little bad debts, not affecting your going concern. Friends, matching principle is the best answer. You see it clearly. Expense of current year, I have recorded uncollectible in current year because the sales, credit sales were recorded in the current year. Now the third one day we talk about the correct financial statement disclosure of accounting policy. Concerning the disclosure is required. When I say disclosure, friends, a simple thing is the notes to accounts. All the accounting policies that you follow must be disclosed in the notes to accounts, and that's why it is integral part of your financial statement. That is nothing optional. It is compulsory. The notes to financial statements are compulsory. Now, the next we talk about the assumption is there. Assumption that the monetary common denominator is there for economic activity. Money being common denominator, and you very well know that the units, monetary unit concept, monetary unit assumption is there. The dollar value of the different transaction, be it be the cost value, the fair value that we will learn, but this value must be stated into the financial statement. And the last one we are done with. We have understood this concept. Hopefully, you have a very nice session to learn about these things. Guys, stay connected for more videos to come and learn together for your best CPA preparation with Phoenix Institution. Thank you to stay connected. Thank you.